Today we're looking at a deep dive analysis for a YouTube video arguing a 75% upside for FUBO stock, all based on the Disney merger and a recent pivot to profitability.
Yeah, the thesis itself is really solid. I mean, you've got these huge catalysts, Disney owning 70%, finally hitting positive adjusted EBITDA. These are game changers.
They are, but the core issue we need to tackle is making sure the presentation has maximum impact.
Exactly. It's a powerful story, but right now it's being told more like a press release than a compelling narrative. The facts are great, but the delivery structure just isn't there yet.
Which leads us right into our first big critique. The material needs to build greater narrative tension to truly maximize the shock and conviction behind that 75% upside thesis.
As it's written now, the video flow, it basically gives away the ending right at the start.
35. So the outcome is revealed.
And then the very next beat is it's now 70% owned by Disney.
So the weakness is that by dropping the conclusion and the, let's call it the Disney shield, in the first 30 seconds, you lose all that powerful contrast.
All of it. The original notes had this great line. Wall Street isn't just looking at what FUBO was, a money-losing growth stock. But the video script summarizes that insight instead of letting the viewer feel it.
You're just telling them the turnaround is great instead of letting them experience the relief of it.
Exactly. If you say Disney is the majority owner up front, you've killed the drama. The viewer has to appreciate just how deep of a hole FUBO was in for that pivot to really land with any impact.
So the suggestion here is to, what, completely resequence the opening?
Radically resequence it. The first 2 minutes should lean hard into FUBO as the struggling, cash-burning company. Only then do you drop the reveal of the two major shifts.
The profitability and the Disney backing.
Make that positive Q3 performance, that plus $6.9 million in EBITDA, feel like a genuine surprise. Make it feel earned.
So you'd start by painting a really vivid picture of the old FUBO?
Oh, absolutely. We're talking years of investors fearing bankruptcy. That's the whole reason the stock got beaten down to these punishingly low valuations in the first place. You have to establish that baseline of fear.
Okay, I see the narrative appeal, but here's a question. For a YouTube audience that wants the hook fast, is there a risk in delaying that big price target? How do you keep them watching?
That's a great question, and it's why you hook on the mystery, not the outcome.
The mystery of the valuation.
Exactly. A concrete way to do this is to revamp the hook flow completely. You hook on the fact that the stock is trading at a historically low multiple, like 0.2x to 0.3x price to sales.
A number which for this sector is basically catastrophic.
Precisely. That ratio itself implies a crisis. So the mystery you're presenting is, why is a streaming company with 6 million subscribers being valued like it's about to be liquidated?
So that's the problem statement. Then you spend the next 90 seconds or so laying out the evidence for why the market is wrong.
The three pillars, the profitability, the Disney ownership. And only then, after you've made the case, do you reveal that $5.35 analyst target. It makes the 77% upside feel like the logical payoff.
That's a much stronger structure. It shifts it from an announcement to a story of redemption. Start with fear, introduce the solution, then confirm the reward.
Yes, it's far more engaging. Now, let's pivot to the second point, which is really about analytical robustness.
Right, making sure the argument can stand up to scrutiny. The material does a good job identifying the counter-arguments, the debt load, the NBC Universal dispute. They call it the elephant in the room.
Which is a good start, but the handling of those risks is where we see the next big opportunity.
So our second critique is this. To create a more robust and persuasive argument, the material has to weave those identified risks directly into the discussion about the valuation disconnect.
Right now, the weakness is that the structure is segregated. You have the bullish drivers, pillars A, B, C, and then the risks are just sort of listed at the end.
Wondering, well, if this bull case is so airtight, why is the stock still trading at $3?
The audience knows the market isn't stupid, right? The market's hesitancy is almost certainly tied directly to that debt and the churn risk from content blackouts.
So the script currently treats them like secondary issues, when really they're the primary reason for the low price.
Exactly. We need to address the source of the low valuation head-on.
Let's just ground this for a second. For our listeners, when a growing streaming company is trading at 0.2x price to sales, what does that signal to the market?
I mean, 0.2x is catastrophically low. It's not just cheap. That's a valuation that says the market thinks the business is fundamentally broken, maybe insolvent.
Is it going out of business sell price?
It is. For context, stable media companies trade at 1.5x to 5x sales. So the market isn't saying FUBO is struggling, it's saying FUBO is terminal.
And that context is so important because it gives the 75% upside thesis its weight. You can now use the risk to justify the low price, which in turn justifies the potential gain.
That's the whole move. So the suggestion for improvement is to use those risks, the debt, the content fights, to explicitly explain why the stock is trading at that dreadful 0.2x multiple.
You're validating the gap between perception and reality.
You are. And once you've addressed those fears directly, you can frame the Disney Shield as the specific solution to those exact problems. It completes the logical circuit. It makes the argument airtight.
So, practically, what does that look like?
Okay, so a concrete example. When you're discussing that low PS ratio, you state, right then and there, that the market is punishing the stock because of the significant debt load. You're nodding to the skeptic, saying, yes, we see why you're scared.
And you have to bring up the NBC Universal dispute. That's a real, current overhang.
You have to. You address it not just as a risk, but as a tangible, near-term reason for churn that's keeping big institutional money on the sidelines, even with Disney in the picture.
So you introduce the problem, but then how do you make that pivot to the solution feel seamless?
Right after you raise the debt risk, you immediately pivot to how the Disney backing, that's Pillar A, is the institutional stability FUBO has always needed.
Disney's ownership gives them better negotiating power for content deals?
And the financial stability to manage the debt. So you're shifting the risk from this insurmountable wall into a manageable challenge that the new FUBO is uniquely positioned to handle.
That's powerful. It takes the analysis from just being strong to being truly persuasive because you've anticipated and answered the most obvious counterargument.
Right. Okay, let's move on to the final pillar, which is Pillar C. This is the valuation mechanics. This is where the 75% price target comes from, so it needs maximum rigor.
Okay, so our third key critique is about anchoring the valuation multiple with specific comparables. The argument driving the upside needs a much stronger foundation than it has now.
The material basically asserts that if the stock just re-rates to a modest 0.5x or 0.8x sales multiple, which it calls common for mature media companies, the price would double.
And while the math is correct, that phrase common for mature media companies is just too broad. It's too generic for an expert audience.
Yeah, the weakness is that overgeneralization. FUBO isn't a mature media company. Not really. It's this new kind of hybrid.
It's a profitable, high-growth streaming company that's 70% owned by a legacy giant.
So a simple comparison to some generic, mature company doesn't feel compelling. It doesn't quite fit. FUBO still has a growth profile that those companies lack.
That's the key. We need proxies that better represent this new entity. The question is, what does that look like?
Well, the suggestion is to find very specific, targeted proxy companies or market scenarios that provide a concrete benchmark.
But is there a risk that if you aim for higher growth-oriented comps, that 0.5x or 0.8x target starts to seem, unrealistic for a company with FUBO's debt history?
That's why precision is key here. We're looking for a middle ground, something that represents a step up from broken stock, but isn't quite at full growth darling yet.
So what are some concrete examples of comps they could use?
Instead of that general phrase, I'd research two specific comparison points. For example, look at a competing company of a similar size that recently hit a major profitability milestone. You could chart its PS multiple expansion after that event.
Or you could look at another company with similar institutional backing from a major content provider.
Exactly. And you have to detail the criteria for the comparison. You have to explicitly say why a company with X scale and Y ownership is a suitable proxy. You need to justify the choice.
That moves the valuation from just theory into something empirical.
And then, the final step is you have to use that anchored rationale to give the analyst targets a real foundation.
Because otherwise, analyst ratings can seem so arbitrary.
Totally. So you tie the conservative $4.25 target from Needham directly back to a potential 0.5x PS multiple, using your more cautious comparable. Then you tie the higher consensus target of $5.35 back to the 0.8x multiple, using your more optimistic comp.
This is crucial. It gives the analyst predictions a clear metric-driven rationale. You're telling the audience the analysts aren't just guessing, they're likely applying this specific defensible multiple.
And that's it. The material's already compelling, but these three adjustments, they're what will maximize the emotional impact and the intellectual credibility of the entire piece.
Okay, absolutely. So to recap the main actionable suggestions here. First, resequence the narrative to maximize the impact of that profitability pivot. Delay the big reveal.
Make the viewer understand the historical bankruptcy risk before you give them the good news.
Second, Integrate the debt and the content risks directly into the valuation disconnect explanation. Use those risks to explain the low price, then show how Disney specifically solves for them.
And finally, strengthen the valuation thesis by anchoring that target PS multiple, the 0.5x to 0.8x range, with two specific comparable market examples.
Give those price targets a robust, metric-driven rationale that your audience can follow and, more importantly, defend.
We strongly encourage you to implement these changes. Once you sharpen that narrative and solidify those valuation anchors, please submit the revised material back in for future critique. We'd love to see it.
Challenging your own structure through the lens of audience engagement is the best